The CFTC meeting right now, presenting proposals for new trading rules as required under Dodd-Frank. The commission, in an attempt to curb speculation in commodities trading, is proposing position limits on 28 physical commodities. Its plans would implement the new rules in two phases and would impact both the spot month and non-spot month contracts. For those of you who don't follow, the spot means today, cash price. Are the new rules necessary to curb speculation? Do we even want to curb speculation? Aren't these, after all, speculative markets? Joining us, John Kilduff of Again Capital, and a CNBC contributor, and Sean Cota, president of the New England Fuel Institute, who left the CFTC meeting to join us. So, Sean, we'll let you go first since you have gone out of your way here. Do we even want to curb speculation? Isn't that what these markets are for?
I really don't think that speculation necessarily is the problem. It's the excess amount of speculation, the aggregate position limits of these funds. You know, when one or a group of parties come and dominate an entire market, that controls a market price. That's manipulation. And the only way you can get a handle on that is to both track them all, both in the current futures markets, but also in the derivative and swap markets, and then set position limits. There was an example in the past of Amaranth. At one point, Amaranth owned 80% of all the natural gas in the United States for the February contract, for the physical portion. You know, if you have anybody that's going to buy 80% of anything, you're going to have huge impacts on price. Now, if you're selling it, that's fine. If you're buying it, it's a big problem. You know, what would happen if in the last 15 minutes of the trading month, someone wanted to buy an option on 80% of all the single-family housing in the United States? Would that make a price impact? Absolutely. Is that good or bad? Well, if you're selling the house, it's great. But if you have to rent it, you've got a problem. And right now, we're seeing the impact on energy. That's just a huge impact. It's we calculate it to be about $1.35 a gallon right now of excess impacts on price that relate to the volumes of money coming in. Speculators are key for the market.
Okay, John, that makes sense to me. I mean, there are some position limits in some futures markets, for example.
Certainly. I mean, and over the years, we've always had some limits, and there's been checks on those who tried to corner markets. And for those who have over the years, I would submit it's ended badly. Be it the Hunt brothers, be it Amaranth. They lost $6 billion in their attempted trade that they were trying to pull off there.
We've got a guy doing it in cocoa right now. We were talking about that in chocolate, right?
Yeah, and good luck to him. I mean, once a position like that becomes visible to the street, you know, generally the forces align up against you, and it doesn't go the right way. I will say that there is some important developments here this morning. The CFTC, because most of the thing I'm worried about here is these markets becoming illiquid and chunky and be more disruptive than some people already think they are. The CFTC is allowing the banks, trading desks that do customer facilitation to grow their books and latch on to the exemption that a counterparty would have. Similarly, if you are an energy company that's got a trading desk that speculates, they're going to allow you to have bigger trading limits around those. So we're going to have some of those big traditional players still in the markets. And I would tell you to watch out now you'll see a lot of these bigger hedge funds hooking up with the oil companies out there that have physical assets that don't have trading desks and vice versa.
So you don't think we need to take all these extra steps? I mean, how do you respond to Sean's putting a number on it, which is what we're always looking for, the $1.35?
Well, I would point out this to Sean's point. I mean, look, we had $12 natural gas. What did $12 natural gas, speculation natural gas get us? $3 and $4 natural gas today. A breakthrough in shale technology that's gotten us an abundance of natural gas. The same is happening in the energy space. We have a lot of spare capacity out there in the world, both on the production and refining side.
So Shawnee makes the case that this will self-correct without a whole lot more regulation.
Well, years ago when I met with the NYMEX, they said nothing cures high prices like higher prices, and that's the case in any bubble. But what investment in commodities as an invesculator, where you're just plowing money into all months in the future, it doesn't translate into actual production. You know, if you want to invest in energy, invest in ExxonMobil. You're buying the assets. They're going to sell into these markets. It'll create production. Buying into commodities is not an investment in the future for whatever the infrastructure is. And in energy, it's costing the consumer about $1.35 a gallon. That's a huge tax. In aggregate, it's about a $300 billion tax that nobody passed. And it's a result of these huge amounts of money going into these markets, particularly in the dark portions that are the derivatives and swaps desks. That all of that needs to be captured and aggregately put in position limits. No one exchange has a monopoly like it used to. NYMEX used to run the day in energy. It doesn't anymore.
We're just about out of time, but I'm intrigued by your number. $1.35 on gasoline. Is that what you're telling me?
That's correct.
Okay. I mean, that would be more than a 100% premium. How do you arrive at that number?
What we've done is we've done some plotting of what the traditional markets had been from supply and demand, and when you add in excess capacities, both in refining and production worldwide, and you plot it against the dollar index. You do all of that stuff, and from the period of mid-'80s to about 2004, it's pretty predictable. Beyond that, it's really about supply and demand of money flows.
Okay.
It's really not about the others.
All right. Sean, John, thank you both very much. Appreciate it. Sean from New England Fuel Institute. John from Again Capital.